Good afternoon. I am Park Cheol-woo, head of IR. I would like to thank everyone for attending the 2025 Q2 Shinhan Financial Group's earnings presentation. In today's earnings presentation, we will have with us the group's CFO Cheon Sang-young, Group CSO Go Seok-kwon, Group CRO Bang Dong-kwon, Shinhan Bank's CFO Lee Jong-bin, Shinhan Card CFO Park Hae-chang, Shinhan Investment Securities CFO Jang Jung-hoon, and from Shinhan Life CFO Ju Sung-han is with us. Today's earnings release will proceed as follows. We will hear a presentation on the Q2 business results by our CFO, which will be followed by a Q&A session. We now invite our Group CFO Cheon Sang-young for a presentation on the quarter's business results. Good afternoon. Thank you for participating in the 2025 second quarter earnings presentation. Let me begin on page 2 with the highlights of our business performance. As of the end of June 2025, the group's CET1 ratio was provisionally estimated at 13.59%, an improvement of 32 bips compared to previous quarter. This was driven by solid group's earnings, the impact of a weaker exchange rate, and continued efforts to manage RWA efficiently. Today, the board of directors resolved to pay a cash dividend of 571 per share for the second quarter and resolved a share back amounting to 800 billion won. Of the total share repurchase amount, 600 billion won will be executed in the second half of this year, and the remaining 200 billion won will be carried out in January 2026. Through this, we'll continue our year-round share buyback program as we have done this year. Including the 650 billion won already acquired in the first half and the 600 billion won scheduled for the second half, the total share back for 2025 will amount to approximately 1,250 billion won. In the second quarter of 2025, the group recorded a net income of 1,549.1 billion won, growing 4.1% to QoQ despite an increase in credit costs thanks to improvements in non-interest income. While the cost-to-income ratio remained stable, the credit cost ratio showed a slight increase due to delayed economic recovery. Next on page 3, moving on to capital. As mentioned earlier, the gross CET1 ratio improved by 32 bips QoQ despite the increased size of share buyback program supported by a favorable exchange rate and a stable net profit. The group RWA declined by 4 trillion won QoQ as foreign currency denominated risk-weighted assets decreased due to FX depreciation, and the group's portfolio was adjusted to prioritize profitability alongside appropriate growth in Korean won denominated loans. Going forward, we will do our utmost to supply funds where necessary, while maintaining capital stability through internal efficiencies and strategic resource allocation. Page 4, assets and liabilities. Please refer to the slide for more details. Next, moving on to page 5, profit and loss. In Q2 2025, the group's net income increased by 4.1% QoQ despite rising credit costs driven by strong growth in non-interest income under a diversified portfolio. As a result, ROE and ROTCE, the key indicators of our value enhancement strategy, each rose by 0.7 percentage point YoY, recording 11.4% and 12.9% respectively. We will explain the details of each item on the following pages. Next, page 6, net interest income. Despite falling market interest rates, net interest income remained flat QoQ, supported by appropriate growth focused on return on capital. The bank's Korean won loan book grew at a similar level to the previous quarter as we pursued portfolio optimization through asset rebalancing while responding to market demand, especially in retail lending. For more details, please refer to page 27. The bank's NIM declined by 16 bips QoQ as yield on interest earning assets, including Korean won loans, reflected falling market rates. However, thanks to adequate asset growth and effective execution of LM strategies, NIM was maintained at the previous quarter's level. Next page is on non-interest income. The group non-interest income grew 34.7% QoQ with improvement across all segments. In particular, securities and FX derivatives-related gains, which benefited significantly from favorable market conditions, led the overall growth in non-interest income.
Let's take a closer look at commission and fees. Credit card fee income was improved from savings and marketing costs, but still sluggish on a year-on-year basis. Meanwhile, brokerage commissions were boosted by active stock market trading, up significantly YOY as brokerage trading volume increased. Investment banking commissions continued growth momentum centered around our banking business, driven by a continued pipeline of solid IB deals. Amid favorable market conditions, we recorded growth in our trust fee income from funds and bank assurance, up both YOY and QoQ. While insurance-related income showed a decline YOY, this was due to the high base effect from last year when SDP or short-term payment policy sales were promoted. Otherwise, we're seeing stable earnings. Next, page 8 on SG&A and credit cost. Group SG&A is under stable management with nothing notable from last year. We recorded cost-to-income ratio of 36.6% in the first half. The rise in credit cost versus Q1 was mostly due to the delay in economic recovery, as well as our conservative management in terms of our loan book, where we recognize more of recurring credit cost in the current period. In the process of implementation of the government-led resolution of real estate PF loans, while we have seen some additional provisioning, mostly from non-banking, it is within our expected and manageable range. Amid the delayed economic recovery, we expect corporates to see rising credit risk, while vulnerable customers will be increasingly challenged. For credit cost, the size may be slightly above our initial expectations, while timing of recovery slightly later than expected. Please refer to pages 9 to 10 for further details on our group asset quality metrics and loss absorbing capacity. Next, on to page 11, net income by subsidiary and our overseas business performance. Shinhan Bank, despite the increase in credit cost, while interest income held up at Q1 levels, while non-interest income was up significantly, thanks to improved fee income from IB and marketable securities, maintaining solid performance. Shinhan Investment Securities has been working to recover from last year's poor performance, improving the competitiveness of its core offerings such as security trust and prop trading to improve underlying business fundamentals. For Shinhan Card and Capital, both remain sluggish amid continued funding and credit cost pressures, but through self-help measures such as asset rebalancing, we expect improved fundamentals and a gradual recovery in earnings. Our group's overseas business continues to return solid performance despite ongoing internal and external uncertainties. Pages 12 through 13 outline our digital and sustainability-related initiatives. And page 14 is on our group-wide inclusive co-prosperity finance initiatives. We have been offering refinancing for borrowers from Shinhan Savings Bank with lending from Shinhan Bank to enhance the credit of our customers. We've been helping customers discover their forgotten dormant accounts while lowering to a single-digit lending rate on all Shinhan Bank household loans, charging 10% or more to help support economic self-reliance and sustainable consumption. We also have institutionalized support to help improve the financing conditions of our customers. Going forward, we are committed to the core role of finance to provide productive intermediation of financing. We will continue to pursue diverse programs for co-prosperity to grow together with our customers as we do our best to become a sustainable financial group. Pages 15 through 18 are more on our corporate value program in terms of implementation, progress, and performance. Relative to the plans announced last year and this year, I can say that we have achieved good implementation results so far. Please refer to the materials for further details. From page 19 and onward, we provide detailed breakdown of group subsidiaries, including financial highlights, P&L, asset management, and funding, so please refer to the pages. In terms of our first half performance and shareholder return policies, we intend to hold a separate IR session for individual retail investors, so we look forward to your engagement and support and your interest. Thank you very much. Yes, thank you very much, and we will now open the discussions to the floor for Q&A. We do excuse ourselves and seek your kind understanding regarding the technical difficulty. Just a bit right there. Please use the raise hand function on your Zoom screens to ask questions.
The first question comes from Jung Jun-seok from NH Securities. Good afternoon. I'm Chung Jun-seop from NH Securities. Thank you very much for this opportunity to ask my question. I have two questions, actually. The first question has to do with the fact that in the beginning of the year, one of your competitors had actually carried out distribution from reduced capital, and yesterday another peer announced that they're considering distribution from reduced capital. I think a similar question had been asked in the past, but there were recent changes in the capital market. So recently, with regards to this issue, has there been a change in your views or position regarding this matter? And second question has to do with the outlook for the second half, especially this year, second half, the economic outlook, and also the credit cost ratio. What is the outlook in the second half? Thank you very much for that question. While we're preparing for the answer, please hold for a few seconds. So thank you very much for that question. With regards to the distribution from reduced capital, our views, and second question was about the economic outlook and also credit cost outlook for the second half of the year. So the first question about the distribution from reduced capital reserves, and the second question about the credit cycle outlook. Our CRO will take that question. The credit cost related question, I'll take that question. With regards to distribution from reduced capital, so at this point in time, as of yet, there is no actually a positive consideration or review that have been undertaken. At the beginning of the year, when one of our peers had reviewed it, we did actually reviewed it. There was a lot of factors to consider, but the regulatory body, I think they are looking into the tax-related issues. And when this conclusion comes out from the regulatory body, I think at that point in time we can do another review. But at this point, we have no plans of engaging in distribution from reduced capital. In the case of our peers, the reason why they have conducted distribution from reduced capital, I think it was partially done to enhance shareholder return, or maybe they were forced to do it because they lacked earnings to distribute. But in our case, as of the end of last year, we had enough actually room, 4,600 billion won, and so we're not in a position to really review this matter. So when there are any changes regarding tax issues or others, but as of now, we have no plans to consider this matter.
Yes, this is the CRO. Regarding our economic outlook for the second half of the year and in terms of the overall asset soundness conditions, as you know, in the first half of the year, across the financial sector, the real economy, domestic, political, and economic conditions, various factors weighed on the prospects for a quick economic turnaround. At Shinhan Bank, of course, it could be in part due to a base effect, but in terms of the number of new delinquencies or the delinquency amount has been in decline. And based on our vintage analysis, within the last 2 years of new loans, the delinquency amount in the last 2 years, from the last 2 years' worth of origination, has been in decline as well. As you know, recently, the supplementary budget will be implemented, and there's the livelihood support voucher program and the bad bank initiative. These government policies are intended to promote consumption while providing support for small merchants. And starting from last year, regarding the real estate PF loans, we have been working together with the government for normalization of the PF loans. So as a result of these efforts, and also there will be an added effect from rate cuts expected in the second half of the year. So on balance, we think that in the second half, cautiously, we may see a peak out of our asset quality metrics. However, that said, given the tariff issue, this is a challenging time. There are tighter regulations against household loans, so we still believe that there are many sources of uncertainty that remain. So we intend to stay on guard and be vigilant in our management. In terms of credit cost, in the first half, just to recap what happened, as we explained earlier, overall, there is a delayed recovery in terms of overall asset soundness. In the first half, we were more conservative in terms of credit assessments, and so that had the result of increasing credit costs. We did additional provisioning against real estate loans as well, which is why, compared to our initial expectations, our actual credit costs were above our expectations.
The CRO talked about the outlook for the credit cycle in the second half. Whenever we do these in earnings presentation, every quarter outlook for asset quality, and we are giving guidance for a credit cost as well. However, this is a difficult year. We have the full year presentation and the first quarter earnings presentation. Whenever we do that, the numbers are actually increasing. So in the first quarter, actually, the number that we have provided was about 40 bips, early 40 bips, but we do believe that the number can go over mid 40 bips range. So internally, our target is for mid 40 bips level. But a credit cost has been dealt with by the CRO. But as asset quality deteriorates on a recurring level, credit cost actually does increase in proportion. But from a conservative point of view, provisioning, if we can move more proactively in this regard, if we do have some room in terms of capital ratio or in our ability to absorb the losses, then we do want to actually absorb the losses in a more conservative manner. That is reflected in our credit cost as well. So all in all, for credit cost, for the outlook for the second half, we do believe our assessment is for the mid to late 40% range, 40 bips range.
Mr. Seo Dong-jin from SK Securities, please go ahead. Yes, thank you for the opportunity to ask. I will also ask about two things. Recently, separate taxation for dividend income, for example, this has been drawing greater interest recently. So if there's legislation and if it does materialize in terms of shareholder return, will there be any changes to your value program? So if you could share your overall directionality and some thoughts. And then second, well, recently there's a lot of talk about stable coins. So is there anything in the works within the Shinhan Group regarding stable coins? Yes, please wait just momentarily as we prepare our answer. Yes, thank you for your questions. I think there were two. First, about the shareholder return mix, and then second, about stable coins. I will take the first question and then pass on the second question to our CSO. Recently, in terms of separate taxation for dividend income, there is a lot of talk going on. And certainly, we are monitoring very closely. However, it's similar for this as well. Like we said, some are saying 35%. There's a lot of speculation, but as to how it will ultimately be decided, we will have to wait and see per legislation. So once it is entered into law, of course, we'll have to think harder about our shareholder return mix. When we first announced our value program, every year and every quarter, we said we will monitor progress and have discussions at the BOD level. And so likewise, this will, of course, be subject to those discussions as well. At our BOD meeting earlier this morning, there were discussions about this as well. However, we still do not know how it will be legislated, so we were not able to review the details. But a key characteristic of our value program is in the pace of shareholder return and also our share buyback. We have a target in terms of how many shares outstanding we will be buying back and canceling. So buyback and cancellation being the mainstay of our program, I think that remains unchanged. And what's fortunate is that in terms of the pace of the buyback and cancellation has been quite fast. So we may not have to wait until 2027 to achieve our target of 50 million shares. So at an appropriate time, we may the mix between dividends and share buyback and cancellations, well, it gives us room to be more flexible in terms of adjusting the mix. And so our PBR, if it's goes above 0.8 times and we have adequate valuation, then rather than through buyback and cancellation, we will actually we could shift toward more dividends to boost cash flow for post-retirement investors, for example. So we will be flexible in reviewing our options and also communicating our results with the market as well. Regarding stable coins, I think, according to the press, well, I can only provide a very high-level generic answer. So 14 banks are studying. There's a consultative consortium in place deliberating about stablecoins, and we are a member of that consortium as well. But again, there has not been legislation yet as to who the issuers will be, where you can use the stablecoin, how the supervisory and oversight system will be. There are many unknowns. But in the longer term, so we will not just stand by not doing anything as stablecoin materializes, but we will look and study hard to how to use this as an opportunity instead of as something that can be a source of concern. Thank you.
We will receive the next question. HSBC Securities, Won Jae-young, the floor is yours. In a difficult and challenging environment, thank you for the solid results, and also thank you very much for paying a lot of attention to shareholder returns. I have two questions. If you look at page 16, when you do shareholder returns, depending on the PBR interval, you said that the plans differ. In the case of greater PBR than one fold, then it seems that there is no mention about share buyback. So if the number is greater than one PBR, then there will be no share buyback. Is that how we should understand it? And then there is no comments on the 1.8 to 1 multiple. In that interval, will the cash dividend move up faster? That's my first question. And secondly, the loan growth, I think, was weaker than expectations in the first half. So in the second half, I think the loan environment will be quite challenging. But even in that environment, are you going to maintain the current pace in the second half, or are you going to increase the pace? And also, what is your outlook for NIM as well? So outlook for the loan as well as the NIM. Thank you very much for the question. While we are preparing for the answer, please hold. So PBR, by the interval of PBR, the shareholder return mix was asked, and also outlook for a loan was asked. So the first question, I'll take the first question, and the CFO of the bank will take the second question. And with regards to your first question, I also actually talked about this during our announcement of the corporate value program. So our principle when it comes to the corporate value is we look at the COE and ROE, and so COE and ROE is looked at, and a balanced approach will be taken. So if we look at the current levels, in order to normalize the PBR, then the shareholder return rate has to be accelerated. And in order to have for this to have an impact, and we do believe that share buyback is actually more effective than cash dividend. And so if we say the PBR is 1, then up until PBR of 0.8, then our principle would be to do share buyback, and then if it goes beyond that, we will actually change the mix. So if it goes over 1 PBR, then will we not engage in share buyback? No, that's not it. Actually, if you look at the overseas cases, up until 1 or 2 PBR, then share buyback is actually effective. There are evidence of that, and so our ROE. And also the rate of recovery and the PBR level, all of these factors will be looked at. We'll be taking a very flexible approach, and also this mix of dividends and share buyback. We'll look at our performance as well as other factors, and we'll discuss this matter with the market as well and decide. I'm Lee Jung-bin, the bank CFO. With regards to asset growth and NIM outlook, that was a question. Let me answer those questions. In the first half, as we have mentioned, our asset growth slowed down a bit, as you have mentioned. In the case of household lending, there was a total quantity-related guidance from the regulator. And so in the first half, household loans have grown by 2.5 trillion won. And so in the second half as well, we will be taking into consideration the policy related environment and manage growth at an appropriate level. And so the corporate loan in the first half, well, in 2024, we have actually increased significantly the corporate loan volume. And so in the first half, we are focusing on profitability as well as margin management. And also in terms of asset quality, we had taken a rather conservative approach in our asset growth management. And so in the case of the corporate loan segment, the growth had been somewhat weak. However, in the second half, based on the portfolio management that was conducted in the first half, we do believe that growth momentum for the corporate side had been secured. So in the second half, unlike the first half, we will be more proactive in the corporate loan market and move forward with asset growth. And also, in the case of corporate loan segment, while we are growing the segment, I think you may have concerns about the margins. Well, in the first half, when we managed the NIM, there was the interest rate related loans, but also funding cost management was very important. So in the second half, if liquidity, and other factors will be considered. So cost management for the funding will be done, and also margins will be closely monitored in order to grow the assets. That is all. Thank you.
So I hope that was a sufficient answer for you. Now, from Mirae Asset, Mr. Jung Tae-jun, please go ahead. Yes, this is Jung Tae-jun from Mirae. I also have two questions. So the capital ratio seems up. So what is your adequate level in terms of an appropriate capital ratio? And YWA, so other than loans, other plans regarding shareholder return, I think it's almost at 50% or so. So do you have plans to deliver above 50% shareholder returns the way some of your competitors have been doing? Yes, please wait as we prepare the answer. Okay, so there were two questions. First, about the adequate capital ratio, I think. Compared to the first quarter, our capital ratio was actually quite improved, I think, on the market. So regarding our capital position, there were some perceptions that we were a little bit tight, but internally. Of course, there was the matter externalities, including FX rates, but there were many efficiency gain measures and rebalancing that helped us boost our capital ratio. So I think you were asking about where we intend to use the capital other than loans. So we do not intend to use it for big projects like M&As, but like our bank CFO has mentioned, at an adequate level, it can go toward loan growth and also toward investments as well. There will have to be an effective allocation. As you know, the Korean economy overall is experiencing many challenges like low growth, sluggish consumption as well. So it's a combination of different factors. So our financing intermediation, mediation to more productive parts of the economy, well, we will be very faithful to that role. In terms of the methodology of exactly how, we will be quite thoughtful as we execute. We do have a sufficient capital buffer, but given the regulatory environment and the macro conditions, it could be subject to change. We said our CET1 ratio would be above 13.1%. So at a minimum, we believe we should manage it at around that level or higher. Given the U.S. tariff issues. There are lots of externalities in terms of the macro. So we do want to be more on the conservative side. Regarding the level of shareholder returns, I think July last year we talked about, we committed to a 50% shareholder return ratio. And I think the reaction from the market found it to be quite revolutionary, quite fresh. Because 2 years ago it was 30%, last year it went up to 40%. And I think now for the other financial institutions, I think some are talking about above 50%. So we are expecting significant increase on our side as well. But in terms of what level is most appropriate, I think I have to maintain a similar tone as before. As to the actual level of shareholder return, 50% by 2027 is our directionality, but we are of course open to different options. But this will depend on PBR, ROE, and the internal management strategy. So these factors will all have to be taken into comprehensive consideration. So we have already announced our shareholder returns for the second half of the year. So if there are any changes beyond those plans, we will try to communicate those new developments with the market.
Thank you for that answer. Now, we will receive the next question from Daishin Securities, Park Hye-jin. Thank you. I have two questions. With regards to credit costs, can you elaborate and give us more details about this area? The bank and the card, I think your write-offs have increased, and also the NPL ratio is not falling. If you look at page 10, rather than the bank in the card, the non-operating assets is growing. During the third quarter last year, I think you said that in the card segment, the delinquency rate or the funding cost is going to be eased. So is that outlook still valid? And also with regards to increasing credit costs, were you taking into consideration the potential increase in NPL assets in the card segment? So asset quality of the card side, can you explain more about that? And the second question is, you said in the second half, the share buyback will be around 800 billion won. And so what will happen in 2005? It's 600 billion, and then in 100 billion will be done in the earlier half of next year. Is that correct? So thank you very much for the question. Please hold while we are preparing the answer. So you have asked two questions. With regards to credit cost, you asked a question, and also share buyback schedule. So with regards to the second question, let me take that first. And the credit cost question, I'll give you a brief overview. And because your question pertained to the card business, with regards to asset quality and also other matters, our card CFO will be taking that question. With regards to share buyback, our BOD had resolved 800 billion won this time round. And what they had clearly resolved was that 600 billion will be bought back by the end of this year, and 200 billion will be bought back early next year. This was the same last year. Because our share buyback program is growing, in order to spread that out over the year, we're taking this approach, and consistently on a fiscal year basis, we're differentiating it. So this year, 600 billion won, up until that amount is what we are doing for this year, and the remaining 200 billion will be done next year. And so that will be next year's shareholder return portion. With regards to asset quality and credit cost, so we are doing some write-offs as well and disposal. The NPL loans are actually growing faster than our initial expectations. That is true. But in the write-off and disposal, we do have some concerns and issues. Because we are seeing growing NPLs, the price for write-offs and disposal is actually coming down very quickly, steeply compared to last year. And in order to manage asset quality, how much of loss are we going to take? So that is actually an issue of concern internally for us. So managing asset quality ratio is very important. So we need to maintain that and manage that at an appropriate level. But there are that concerns. And regarding the card business, I think our card CFO can provide you with more sufficient answer. So this is a card CFO. As we have have explained already about the delinquency during our last presentation. New delinquencies is actually something that we're focusing on. So 2 months overdue overall rate, that's a key indicator. After the impeachment last year, the number has grown steeply. And internally, we are taking a lot of actions so that by February, the delinquency rate, roll rate, actually it peaked at 0.45, and then in July it's about 4.1 that we're expecting, so it's improving. However, recently, in order to stabilize the housing prices, loan provision is being limited, and so that impact will be felt in the next couple of months, and we need to closely monitor the market. So in the current situation, we have peaked out and we are coming down. That is the trend that we are observing. And you talked about NPL loans also. The delinquent loans are becoming NPLs, and we are managing that through write-offs. And in the case of NPL ratio and also the delinquency ratio, in order to ensure that those are not growing, we are actually increasing the write-offs. So the rates will be managed at the previous level. Thank you.
Okay, there are no questions pending. So we do have another question from Hana Investment Securities. Kim Do-ha, please go ahead. I just have one final question regarding real estate trust. I do understand there was a legal litigation. There was some write-up in the press about it. So I think regarding your provisioning against that kind of litigation, I understand there is some set aside. So additional provisioning, how much do you expect to have to set aside further against this kind of real estate trust type exposure? Yes, please hold on as we prepare the answer. So in terms of real estate trust, I think within the industry, if you look at real estate trust companies, based on their financials, a lot of them are still loss-making, and the sector remains still challenged. For us, you'll remember last year, we actually saw a significant loss, which was reflected into our closed accounts. So we wanted to be preemptive in terms of absorbing against that loss. So our provisioning there is a significant buffer against that kind of loss. Regarding the litigation, we actually set aside about 25 billion in provisioning against that kind of loss. But still, for Shinhan Real Estate Trust, although profits actually have gone down compared to historical levels, we have seen uptrends in the second quarter. Now, it depends on the real estate market. So if we suppose that the downtrend continues, then the expected recovery amount, of course, will become smaller. So there may be additional loss in that case. But at a high level, for the most part, we have set aside our required provisioning. So it's already done. As of June, we have about 380 billion in loans to the trust account and 340 billion in provisioning against that exposure. So it's almost full coverage. So rather than a large sum loss, we could potentially can have a little bit of loss depending on the real estate business cycle. But in the larger scheme of things, we have good provisioning already. Yes, thank you. And we will move on.
Yes, Kim Ji-won from Dow Securities. Thank you very much for this opportunity to ask my question. I have questions about the securities. Recently, Shinhan Securities brokerage market share is going up, and IB-related activities is also growing as well. So in terms of contribution to the non-interest income, what areas of business is securities business focusing on, or are you diversifying, trying to diversify? And also, I think you have asked for a new issuer license. What kind of business are you pursuing based on that license? So thank you very much for the question. Please hold while we are preparing the answer. Yes, I'm the CFO from these securities. Thank you very much for those questions. With regards to the brokerage IB fees, going forward, the income that we anticipate for the past 4 to 5 years, WM and IB focused growth was pursued, and we had the private equity issue, and then the alternative investments in overseas market. We had incurred some losses, and so retail WM and IB has been rather sluggish. That is true. And as you have said, the asset management, WM and IB segment, yes, we are trying to enhance profitability in these segments. In the case of overseas stocks, MS, even if those are included, it's over 5% in terms of MS, and the brokerage income continues to grow in this segment. In the IB, in the first half compared to last year, there's been an increase of about 20 billion won of underwriting fees. So our fundamentals are actually improving. That is our internal assessment. However, for potential loss factors, potential default factors, we are actually closely monitoring these issues, and we will be preemptively removing any of these uncertainty factors. And also the issuer license acquisition, I think this is a cautious issue. 5 players have applied for this license, I do believe. And with regards to this matter, we're taking a cautious approach. We have engaged in a thorough review of this and a more aggressive or proactive the existing issuers rather than those kind of aggressive growth approach. Is aligned with the government policies, and then also conservative growth, and also in order to align with our group's portfolio about these kind of assets. So the profitability and the growth of this segment, we want to pursue all of this in a balanced manner. That's how we have constructed our portfolio, and so we have done a simulation of various scenarios. And so no, we are preparing the business to ensure stable growth. Thank you.
Mr. Kim Jae-ho from Samsung Securities, please go ahead. Yes, thank you for the opportunity to ask. I just have some brief questions. First of all, you mentioned credit costs. You talked about mid to high 40 basis points for the full year. If I do the math, for the second quarter, I think you're around 60 basis points. So 50 basis is just on a cumulative basis. For second quarter, it's 60 basis points. So typically in the fourth quarter, it does tend to go up. So are you expecting that in the second half, the credit cost is likely to go down more to achieve that full year goal? And then there was a lot of fee income from derivatives and other marketable securities. So since it has gone up already, is there room for further upside? Was it more of a one-off, or what are your expectations for the second half? And regarding your collaboration with Jeju Bank, could you provide some progress updates? And if this goes well, is there a possibility of expanding it further? Yes, yeah. Let us prepare to answer. Just one moment. First, regarding our credit cost outlook, I think you asked about some of our underlying grounds for our outlook. If you look at just the second quarter at 60 basis points, if these trends continue, of course, mid to high 40 basis points will not be achievable. So for us, we are looking at recurring trends in the third quarter. Are there any big factors in the third quarter? So we have run simulations, and we are expecting a slight decrease in credit cost going forward than the second quarter. Then marketable securities and derivatives. In the rate cut cycle, although our interest income goes down, this provides a boost to our overall earnings. But this is correlated with macro factors. So the stock market, how active it is, and the Kospi index and the capital markets, the market interest trends. So these will be factors. So I cannot say it will go way above current levels to see explosive growth, but market interest trends and also the Kospi activity that we have seen starting in the second quarter makes us believe that this kind of uptrend is likely to go up. And there wasn't any one-off factor driving up derivatives. It's not so much valuation gains, but there's a lot of volatility in the FX rates, for example, that can lead to gain and loss. And so that said, we see remaining potential there as well. And then regarding the collaboration, yes, we are working hard on the collaboration with Jeju and Dorjeon, and we have experts from our side at Shinhan as well. So together we have a team of 40 people from all parties making the overall preparations starting in April this year. So like we said, the target is end of first quarter to provide meaningful products available to SMEs or small business owners. And so we are working in line with the schedule. In terms of expansion, I think that's a matter for later after we do a successful launch of the initiative first. So that is it.
Thank you very much for that answer. Today is a number of financial groups have their earnings presentations, but our time is up, and we'd like to conclude today's earnings presentation.
And we have a bit of housekeeping announcement for our retail investors. Our CFO did mention, but on August 28th, we intend to have a individual IR session for retail investors through our Shinhan Financial Group YouTube channel, same as last year. So from today up to August 4th, you can apply to join on our website. So during that IR session, we will entertain your questions. So please upload your questions on the group website in advance of the IR session. So any questions that were not covered today, please go ahead and let us know by uploading them onto our home page. So more information will be provided through our website and the DOT site as well. So we look forward to your interest. And with that, we will conclude our earnings call for the second quarter. Thank you.